Camera 1 in position. Camera 2 stand by. Camera 2, we're taking you in 3, 2, 1. Take camera 2.
As the global financial system came crashing down in the autumn of 2008, the world watched in disbelief. Now, as we clean up the mess and try to make sense of what happened, we're learning that part of the problem was the banks had picked up a debilitating gambling habit. And even worse, they thought they had a system which guaranteed a win.
They were headed for disaster.
The checks and balances that were supposed to catch problems failed at both the corporate and government levels.
What on earth was the board doing? Was there nobody trying to stop them carrying on as they were? What was the regulator doing?
In this programme, we'll assess what steps we can take to build a better system of gatekeepers.
The role of a good non-executive director is to be the grit in the oyster, because from that we create pearls.
Rather than constantly passing the buck, how can stakeholders step up to their responsibilities? On September the 17th, 2008, just days after the collapse of Lehman Brothers in the United States, emergency negotiations began in London to allow UK banking group Lloyds to bypass competition rules and take over troubled bank HBOS.
Lloyds, TSB and HBOS are in advanced merger talks. HBOS stock at one stage dropped another 50% this morning in the UK.
We have been so volatile this morning. The FTSE opened up around 50 points. It was down at 60 points at one point.
We're going through extraordinary times. Minute by minute, the story changes.
I would have thought the balance sheet was perfect to actually do the deal, but can it be done?
You can't overstate the importance of it. This is the biggest mortgage bank, savings bank in the UK.
The £12 billion deal appeared to save the UK banking system, but the takeover would prove disastrous. 1 month later, following bad loans and big losses at HBOS, the UK government bailed out the bank with £17 billion. By March 2009, it held a majority stake.
Lloyd's acquisition of HBOS is a good bank trying to go after the balance sheet of a weak bank, and the weak bank basically pulling down the entire ship.
Watching in the wings was former head of risk at HBOS Paul Moore, a man who claims he lost his job when he blew the whistle and warned his bosses about the bank's reckless and excessive lending.
It was perfectly clear to me, and I reported it clearly, that the sales and marketing culture in the bank had got completely out of balance with the ability to control it through proper standards of risk management, proper internal control mechanisms, etc.
Let's address that first question of exactly the mess that HBOS got itself into.
They have written off somewhere between 12 and 15% of the entire loan book of the corporate bank in less than 6 months. What on earth was the board in HBOS doing? Was there nobody trying to stop them carrying on as they were? What was the regulator doing? And that's one question. The second question is, why on earth did Lloyds buy them? Did they just close their eyes and sort of say, oh, we're going to become the biggest, therefore we'll buy them? Extraordinary questions for both boards in terms of their acting with due skill, care and diligence, and potentially even issues about integrity and so on.
Paul Moore wasn't the only one who'd spotted that the system of corporate checks and balances was failing.
There's no question boards of directors have done a terrible job in providing any kind of meaningful oversight.
Nell Minow heads the Corporate Library in Washington, D.C., a watchdog organisation that lobbies for better corporate governance.
At my company, we rate boards of directors. We gave bad ratings to all of the bailout companies for about 2 years because we could tell that just because of the way their compensation was structured, they were headed for disaster.
In the years leading up to the crisis, bankers were being encouraged to make risky bets, essentially gambling on whether some of the poorest people in America were going to default on their home loans.
The risk-taking was completely out of control. For example, with the subprime loans, the compensation was based on the number of transactions rather than the quality of transactions. You didn't have to be a rocket scientist to figure out that if you were in that business, you just wanted to move as many transactions across your desk as possible and not waste time trying to look at them and see if they were legitimate or even if you understood them. Just move them, because by the time they fell apart, they would be somebody else's problem.
So management, traders, risk takers, they were all funding long-term assets with very short-term debt. They were taking lots of, I would say, tail risk that would materialize just once over a cycle rather than every other quarter. And they were doing this in huge proportions.
It wasn't just investment banks taking these kinds of risks. Commercial banks had also raised their stakes, jeopardizing the deposits of ordinary customers.
In the main banks, I would like people to behave responsibly, carefully, orderly. People don't behave like that if they're on packages of 500% of salary and bonus or nothing, at which point they will take rash risks, they will cover things up. It's an encouragement to dishonesty, it's an encouragement to complexity.
In the modern world of shadow banking, complexity had certainly increased. Credit default swaps and collateralized debt obligations bundled bad loans in with good and offered insurance against default. But they did so with a convoluted series of transactions difficult to decipher.
If you look at the calculations that were used to send the rocket ship to the moon, that would not begin to show you how complex these financial formulas were.
There are auction rate securities backed by collateralized debt obligations that are backed by collateralized debt obligations, backed by collateralized debt obligations, known as CDOs squared or tripled. And then within each of those securities, you have to determine what all of the underlying securities are.
This mathematical wizardry appeared to eradicate risk, and those in charge were willing to put their trust in these elaborate equations.
I'm not saying that the board of directors has to be able to pull out their slide rules and make them all work, but I think it was idiotic of them to believe that risk could be taken out of that series of transactions, and yet they behaved as though it had been.
The magical formula that guaranteed a win might in hindsight look dubious, but while the profits were rolling in, few thought to question the system.
It is actually a failure of morality, it's a failure of character, that these directors and non-executive directors did not have the courage to stand up and question the purpose and the strategy of the organisation.
I hope it's been a good learning experience for us all, that it's okay to ask the dumb question when you don't understand something.
In essence, what this crisis might boil down to is that nobody was prepared to ask the dumb questions, perhaps for fear of the answers. As it turned out, the system was flawed, and bankers' bets were in fact badly placed. Banks and insurance companies incurred hefty losses and plunged deep into the red. Many had to be rescued by government money, but even as they accepted bailouts, it seemed top executives weren't losing out on their bonuses. Huge bonuses might make sense when a bank is doing well, but people find it particularly galling when failed or part-nationalized banks reward employees and allow executives to walk away with millions. With many of the issues surrounding the banking crisis hard to grasp, here was one that seemed pretty simple, and people were angry.
Mr. Sullivan, you're all embarrassed by some of the things that were said in there, sir?
Hey, hey, what's the fun? Make the economy work for us.
Why'd you get the bonus formula changed, sir? Mr. Sullivan, is there anything you want to say to taxpayers or investors?
When failed insurance giant AIG announced an executive bonus pool of $165 million, the indignation went right to the top.
It's hard to understand how derivative traders at AIG warranted any bonuses, much less $165 million in extra pay.
This has indeed been a gilded age for executive pay. When you look at how much their pay has grown in proportion to just the average worker, how the types of incentive compensation have exploded and the varieties of ways executives are being compensated, you just have to wonder, how much do these individuals need to be incentivized to work? It just makes no sense.
Politicians are responding to the public outcry.
They just forget anything's ever happened, so people are very angry. So you need to talk to somebody.
US Congressman Barney Frank chairs the House Financial Services Committee. He's not opposed to bonuses per se, but he wants to change how they're awarded.
You can give bonuses if you want to, of course you can, but you can't have a situation where the individual decision maker gets rewarded if he made a good guess and makes no penalty if he doesn't. Heads I win, tails I break even, you flip too many coins.
In hearing rooms around the world, there's likely to be much debate ahead on ways of structuring compensation. Ideas on the table include deferral, transparency, and clawbacks.
I'm a very strong supporter of clawbacks, meaning that if there's any correction in the future to the numbers on which the bonus was based, then you have to give that money back.
The issue stands at a crossroads. Some argue too much government intervention may stifle competition. Others say without it, nothing will change. And past experience tells us that even slashed salaries have a way of creeping up again.
Compensation has become the many-headed hydra. You cut off one of the heads and two more grow back. Whenever we've had some pushback on executive pay, there's been some adjustment in behavior, but then you'll find that executives are rewarded in a different way.
In the years leading up to the meltdown, the excessive pay packages of top bankers grew to reflect their role as supreme commanders of the institutions they ran. Rarely were they told no.
Regardless of what comes out of
With powerful CEOs heading up most banks, fierce competition and ego have become the key drivers of business. Yet first in line to challenge the CEO should be the board of directors.
The board of directors is there to essentially tie him to the mast and prevent him from being distracted by the siren calls of investment bankers who want him to do transactions or other kinds of distractions. Unfortunately, in our current system, the CEO picks the board of directors, and so they're therefore not inclined to tell him when he's getting out of line.
So we definitely need contrarians on the board, and we don't need to stuff them full of bankers. That's a big mistake.
We need other skill sets to introduce a challenge to groupthink, which can happen in a rather cozy financial environment.
The key question for every director is what could go wrong, not what will go wrong, what could go wrong. And unless you hear from people who have no incentive to sugarcoat that answer, you will be left unprepared for the next catastrophe your company will experience.
The breakdown of the financial system has wiped billions off the value of banks. The owners of the banks, the shareholders, have certainly been the victims of the collapse. But did they also contribute to the cause? And will they now rethink their role as gatekeepers?
Please hang up and try again. Please hang up and try again.
beginning of a new financial age, the world of risk had changed. But the changes had largely gone unnoticed. Casino-style speculation had gotten more and more out of control, and the checks and balances that should have been in place to rein in the risk were nowhere to be seen.
Power-hungry CEOs were driven by short-term profit, and many claim the executive boards were complicit. But surely the owners of these banks would have something to say about the way things were run. Wouldn't the shareholders care about the company's future?
Actually, the owners were very often, if not encouraging, complicit in activity that led to higher leverage in banks.
Fingers point at institutional shareholders, like those handling millions of pensions. They should have a stake in the future health of the companies they invest in. Yet though time would seem to be on the side of these long-term funds, paradoxically, the money is managed in a short-term way.
The accountability of the firms that failed wasn't to those who were interested in their success. It was to intermediaries who were trading their shares. And there's a disconnect then, or a lack of accountability, which I think is behind the problems we saw.
Fostering a more long-term view will mean a radical change of mindset. Perhaps even redefining how to act in the interests of the investor.
Perhaps we need to go back to fiduciary duty and the definition of what it is to be a fiduciary, to hold something in trust for another, such as a pension fund trustee, and reconsider that from a longer-term perspective in the context of the good of the fund and its beneficiaries.
There are many parts of the puzzle that need to be addressed, from corporate boards incentivizing management for the long term, undertaking long-term projects that may end up impacting the company negatively in the short term, but expecting that over the long term those are value added. I think that would motivate investors to hang around.
The crisis is a wake-up call for end shareholders to actually care about what happens to the institutions they invest in. At Hermes, CEO Colin Melvin is working with 12 long-term investors to pool resources and call companies to account.
We represent them as owners and engage with companies and vote the stock and deal with the policy and best practice on their behalf. I think this kind of vehicle that we have at Hermes will grow up elsewhere, and I think also the trades bodies that represent the end investors, the pension fund associations, the insurance company associations, will all develop a similar sort of approach.
If shareholders can't pay attention to these issues and notice them, if they can't stop these things before they get out of hand, then we're going to be in an endless cycle of failure.
What do you have to say for yourself? What do you have to say to the public, to your investors?
This crisis has revealed that perverse incentives and a failure of oversight are a recipe for disaster. But it's not the first time in recent history that we've come across the problem.
People were compensated quite well, tens of millions of dollars, based on closing deals. As soon as a deal was closed, the company could book the profit.
Though it sounds familiar, in this case, it's not bankers we're talking about, but a company that went spectacularly bust in 2001 after an accounting fraud, US energy giant Enron.
Essentially, Enron was a company on steroids. It appeared to be robust and healthy, but the way that it created that appearance was by relying on illegal transactions to make itself look like it was more profitable than it in fact was.
Andrew Weissman led the federal case against the Enron executives. People went to prison for what happened.
With today's arrest of Ken Lay, the top echelon at Enron has now been called to account for their crimes.
But so far, with the exception of rogue individuals like Bernie Madoff, that hasn't been the situation this time around.
There may, in fact, be people who committed crimes related to the current financial collapse that we're in, but I don't see anyone saying that the reason we are where we are today is because of the kind of fundamental fraud pervasive in Enron.
Sir, how do you feel? You dead?
Mr. Madoff, what would you say to all those people that lost money, Mr. Madoff? What would you say to them?
It's the greatest financial fraud in American history.
It's now likely Bernie Madoff will die in jail.
150 years in prison. This judge has thrown the book at Bernie Madoff.
I think in a way it was almost a relief when Madoff got arrested because that was a good, clean crime. We understood that. But with regard to the kinds of things that went on with the credit default swaps and the subprime mortgages, that was all legal.
In the wake of the Enron scandal, US policymakers introduced a new set of laws known as Sarbanes-Oxley to improve financial reporting and increase transparency and accountability.
Sarbanes-Oxley attempted to address some of the issues that came up with the failures of Enron and WorldCom and the other companies. It strengthened boards of directors, strengthened the oversight over accountants. Previously, accountants had monitored themselves. The government decided that wasn't going to work anymore. It put more disclosure rules on companies, and it provided a little bit of an incursion into the traditional American notion of giving state control over corporate governance.
Yet that didn't help us avert the recent breakdown, because what the new laws didn't do was legislate on business risk.
There's nothing in Sarbanes-Oxley that promoted a greater awareness of risk assessment. And that's something that now every corporate board has to take into account as part of its responsibilities and its functioning of oversight.
Post-crisis, many are demanding more regulation to prevent something of this nature happening again. But lessons learned from Enron suggest that regulation can only get us so far.
Many people dealt with the discipline that Sarbanes-Oxley tried to impose, but unless directors are focused on what the purpose of these requirements are, then you wind up with a check-the-box mentality.
There's certainly a clear danger in having a box-ticking mentality, because what happens if you tick the box, then you think job done. So more rule compliance, more regulation stops people thinking. You're not allowed to question this. You just tick the box and carry on. That's insane.
What corporations need to avoid, according to corporate ethics expert Roger Steer, is becoming massive machines where individuals are simply cogs and when at work assume no personal responsibility or moral values of their own.
The problem we have is that we are creating a morally infantile civilization where people think that greed, fear and ego are the drivers for grown-up adult behaviour. They are not. If, however, we have the moral values of self-discipline, humility and courage, which research has shown drives sustainable value, we're going to see less of these catastrophes going forward.
But self-discipline, Steer says, is something companies need to actively cultivate within each and every employee.
We need to be assessing the character of all the key players in a corporation, starting with the board, directors and non-executive directors, then the senior executives, and ultimately, why not all employees? We measure their competence in certain technical areas, but who measures the moral character?
Now that ex-HBOS risk manager Paul Moore is out of a job, he's had plenty of time to reflect on ethics and moral values.
The love of money is the root of all evil. So you've got a kind of push me, pull you happening. I say this, yes, we should focus on ethics and morality, but in order to do it, we have to have a regulatory regime to allow that to take place and to enforce it when it doesn't. You can't just hope that it will happen.
What are the truly effective ingredients then of a control system that works and would meet the Paul Moore standard?
It's very simple and it's very profound. You need to remove the internal control functions, that is risk management, compliance and internal audit, from reporting to the executive and have them reporting directly into a dedicated non-executive. You therefore separate the power between the executive on the one hand, who implement a strategy, and those that are supposed to be checking out, challenging assumptions, challenging paradigms, and so on.
But how do you get the right balance? Because the CEO has a clear function, and at times their role might be to take risk because that's what the company needs to take it forward.
You're like many other people that think that risk management is about not taking risk. That's not what risk management is about. It's about understanding risk. Formula One racing holds less residual risk than angling, which shows you can do something very risky at the same time as managing your risk. Risk management is about taking risks, understanding the level of risks.
Yet in this crisis, the risks weren't understood, or even worse, they were outright ignored. From CEOs to boards to shareholders, nobody accepted responsibility. And what we've discovered is that when the buck gets passed, it has to stop somewhere.
Ultimately, it has to stop where? It stops with citizen taxpayers. The buck stops with us. We've just seen the masterclass in where the buck stops.